Okay, welcome everyone. I really appreciate every one of you who came out tonight to listen to what I know doesn't always sound like a fascinating thing to everyone, but it's really important because taxes fund all the services that we depend on. And where Congress is ready to do or planning to do a very large tax overhaul. And there are many, many things I think you need to understand in order to understand whether the ideas and changes you're hearing are a good idea or not. So I've asked Gregg to do a very nonpartisan, factual presentation. And he's going to cover a lot of bases. I think if when he's doing something, if we have a question that to clarify something right there, we can do that. But more substantive questions, we'll wait till the end and take. And I think that I should introduce Gregg. This is Dr. Gregg Woodruff. He is the chair of the Accounting and Finance Department. He's also a CPA and a very interesting accountant. Not a dull one.
Thank you. All right, well, tonight we're going to go ahead and talk about tax basics and some of the proposed changes that have been put forward in the press by Donald Trump. And so before we start, we're going to have two examples. We're going to have a single taxpayer, and I'm going to call him Sam Single. And then we're going to have a couple that files their tax return together, and I'm going to call those folks Marie and Philo jointly. The information that is interesting is that Sam inherits $100,000. And Maria and Philo, they also inherit $100,000. Sam earns a salary of $100,000 annually, and Marie and Philo combined earn $100,000 in salary. They went to Western Illinois University, and so they're paying off student loans, and they have $2,000 a year in qualifying student loan interest that they can deduct in determining their taxable income. They also have mortgage interest that they're paying on their home, $6,000 a year that qualifies for a deduction. They have property taxes of $4,500 a year, so they don't live in the biggest house in town, but they live in a nice house. And Sam does not make charitable contributions. He's a younger fellow and hasn't figured that out yet. But Marie and Philo, even though they have a couple of children who are 18 years of age and not going to school, they make charitable contributions of $10,000 a year to the foundation. So that's our starting point. So let's see what happens to Sam Single in 2017. If we add up all the quote, income that we would think of broadly, is $200,000, the inheritance from the estate, and the salary of $200,000. But the tax code says you don't have to include an inheritance in your taxable income. So Sam's gross income is $100,000. From that gross income, he can subtract the student loan interest of $2,000. That's called a deduction for adjusted gross income. So that leaves Sam with $98,000 of adjusted gross income. Then he gets to take the standard deduction because he has no itemized deductions. And so that was $6,350 for 2017. He gets a personal exemption. Okay? The government says, well, you know, you're going to have some medical costs and things that don't rise to the level of being deductible. So he gets this personal exemption, just cost of living, $4,050. So his taxable income after we subtract that is $87,600. When you calculate the tax on that, Sam's tax liability currently would be $17,639. So where did we get the standard deduction? Okay, well, the standard deduction for a single taxpayer in 2017 is the $6,350 that you see up here on your left. And then we're going to take a look at a moment, and we'll see that the married filing jointly standard deduction is $12,700. Personal exemptions for 2017 and 2016 are $4,050 per person. And this phase out basically says if you make too much money, you don't get the personal exemption. You don't need that extra help. So the IRS prepares tax tables and tax schedules. And rather than put 100 pages of tax schedule or tax table in front of you, we just went ahead and we have the single tax schedule at the moment. And you can see that if you earn $9,325 or less that is taxable, your tax rate is only 10%. Once you earn more than $9,325 until you owe $37,950, the tax rate on that next bracket of income is 15%. So the first pile is taxed at 10%, the second pile is taxed at 15%, and as we go on, we'll see that if we have taxable income between the range of $37,950 and $91,900, that our tax rate is 25%. So that's going to be very important. We want to remember that the tax rate in that column is 25%. So what taxes did Sam encounter? Well, a lot of folks need to understand the difference between the average tax rate, the effective tax rate, and the marginal tax rate. So the average tax rate is this going to be the tax liability, the taxes that he owes, divided by his taxable income. So even though he's moved up into that next bracket, his average tax is still only 20.14%. His effective tax rate is the tax liability divided by his gross income. And that's the 17.64% because it's the tax liability over that 100,000. His marginal tax rate, when we looked back at that previous table, is 25%. That means the next dollar of income that single Sam earns, or Sam single earns, excuse me, is going to be taxed at 25%. So let's look what happens to Marie and Philo jointly. They still have that same $200,000 of broadly defined income. And just because they're married filing jointly doesn't mean that they have to include the inheritance in their taxable income. It's excluded. Okay, it's excluded. So their gross income is still $100,000. And they get to deduct that qualifying student loan interest to determine their adjusted gross income, which is also $98,000. But here's where they're different from Sam single, right? They have some itemized deductions. They have $4,500 in property tax. They have the $6,000 for the mortgage interest, and they have $10,000 that they gave to the WIU Foundation. Okay. So when we add that up, that's $20,500. And that's more than that standard deduction that we saw back on that earlier page, right? So they're going to take the itemized deductions because that gives them the better value for reducing their taxable income. Then they are allowed two personal exemptions, one for each of them, right, the husband and the spouse, and they have two dependency exemptions for their 18-year-old children. The children still live at home with them, but they're not going to school. So those total up to $16,200, so you can see that their taxable income is $61,300. So those extra deductions really helped out. And their tax, the amount that they owe, is $8,263. So when we look at this, married filing jointly, they have a different tax schedule and they have a different set of tax tables or column for calculating their income tax payable. So the first $18,550 will be taxed at 10%. After that, the next $57,250 will be taxed at 15%. So that income between the $18,650 and the $75,900 is taxed at 15 cents per dollar. Right? As they go up, that marginal tax rate increases, so that we start paying 25 cents on the dollar, 28 cents on the dollar, 33 cents on the dollar, 35 cents on the dollar, and then 39.6% if we're what they call a high roller. So what are those tax rates that Marie and Philo encountered? The average rate for them is 13.48%, that $8,000 or $8,263 divided by the $61,300 in taxable income. The effective rate, the $8,263 divided by their $100,000 is 8.26%. And their marginal tax rate, the tax that they're going to pay on the next dollar of that earned income, is still going to be 15%. Now, I was asked to briefly talk about tax credits. Well, tax credits are better than deductions. Deductions just reduce our taxable income, but tax credits are directly subtracted from the tax that you owe on your taxable income. Okay? So tax credits get included in how much did you pay before and what was held, and then they go ahead and subtract those credits too. There are two types, refundable credits and non-refundable credits. The refundable credits are the really good ones. Even if you have no tax bill, if you don't owe the government any taxes, but you have a refundable credit, you're going to get a refund check from the government. If you have a non-refundable tax credit, if you have a zero tax bill, well, you just don't get that credit. But if you have a tax bill, it will reduce it down to zero. Both of them are good, but the refundable is better. An example of a non-refundable tax credit is the general child tax credit. Okay? That first part of the tax credit is non-refundable. However, there is an additional child tax credit that is refundable, and that applies to families that have 3 or more children. Okay? And then the other one that is a refundable tax credit and has been very helpful for low-income families is the earned income credit. When I was in school, I qualified for that for a while, and in my first teaching job, I qualified for it. So very helpful, and this was the brainchild of a guy named Richard Nixon. So for all of his problems, he came up with something that was quite useful for our low-income families.
Yeah, for low-income families, a lot of them make so little money that they don't have to pay any income taxes. They fall below once they take the standard deductions out. But they'll get this earned income tax credit refunded to them. So even if they don't pay any income taxes, they get it's considerable too. It's about
anywhere from $3,000 to $6,000.
Yeah. So they often get $3,000, $4,000, $5,000 back at the end of the tax year if they've been working.
That's right. So the president has suggested a new tax rate schedule. And so in the press, they have suggested that the old income tax brackets of 10 and 15% will be merged into one, and it'll be a 12% bracket. That the 25 and 28% brackets will go into a single bracket of 25%, and that the 28 and 39.6% bracket will be at 35%. Yet the president has indicated that actually he'd be comfortable with that, not having that at 35%, but at having it 39.6%. But at the moment he doesn't think he could get that one through Congress. So you can see that for the single taxpayer, you have fewer brackets. The marginal tax rates increase quickly. For the married filing jointly, we still have just the 3 brackets, but you can see that the 35% rate applies once they get above $225,000, whether you're when you're married filing jointly, and only $112,500 when you are single.
Just a minute, Greg. If people in your handouts, if you look at the 5th one, the single tax schedule that's current with the 7 rates now, And then they're proposing going to these 3. And one thing you'll see is that when you collapse these rates, one change it's going to be, let's see, let's look at the middle rate there. It's from 37,000 to 112,000 of income. And in that range, 37,000 to 112, it covered 3 tax rates on this table. And so those people, some of them will be in a higher bracket than they would have been before. And in some cases, when you get up to the higher bracket, those people in the highest bracket, the 35%, some of them were in 33, some were in 35, and some were in 39. So again, some of them will go up and some of them will go down. And in particular, those people in that top 39.6% are going to go down.
That's right.
That is the top 1% of people are
That's
the
correct.
only ones in that bracket.
Like I said, that's the effect if they go ahead and go with 35%, and that's what is in the media at the moment. But the president has indicated 39.6 would be just fine with him, but he also said that he doesn't think he can sell it.
Of course, at 112, you're not in the top 1% of income.
No.
I mean, so you wouldn't want to put all of them up into 39.
No. No. Okay, so let's take a look at single Sam back under that new plan. So the same income currently that they had the inheritance, and we're hoping that the exclusion remains, and so that his gross income still remains at $100,000. There's no deduction for the student loan interest, and so his gross income remains $100,000. So now his income is already higher. Then he gets the greater of the itemized or standard deduction. Well, the proposed standard deduction is $12,000 for someone who is single. He has no itemized deduction. So on the standard deduction, he's a winner. But because he lost the student loan interest deduction, he's at $88,000 in income, and that is greater. And then he has his tax, which is $17,125, calculated with that Trump schedule. So his tax, Sam Single, is taxed at $514 less than currently. So what happened to Sam's rates? Well, this is one of those things where, you know, if they tell you about the savings, you look his tax rate is 19.46%, his effective rate is 17.3%, and he remains in the marginal tax bracket of 25 cents. So the next dollar of his income will be taxed at 25 cents. So let's look at Sam's old rates versus his new. His old rate was 20.14%. The new rate would be 19.46 for the average. His effective tax rate would go down from 17.64 to 17.13. And his marginal rate remains consistent. But here's where we start to run into some bigger problems. So here we have Marie and Philo, and they still have the gross income of $100,000. They lost their student loan deduction, because that's one of the things that's supposed to go. So adjusted gross income is now $100,000. And so it's the greater of the itemized deductions or the standard deduction. So because they're not going to have a property tax deduction in the proposed bill, his itemized deductions would only total $16,000. So $24,000 is a winner. But he loses, or the couple loses, their personal independency exemptions. So they lose that $4,050 per spouse and the $4,050 per child. And so we can see, my golly, they have a big increase in their income. Their income has gone up by $14,700. Their tax is now $9,250, and the amount that they owe for their taxes is now greater by $986. So the families who will suffer by this are the families who have property taxes, the families who have children. So if this married filing jointly couple were like single Sam and lived in an apartment and had no children, they would be doing okay. But
Okay, so let me understand this. Right now, every filer can take the standard deduction if their deductions aren't more.
that's correct.
And that standard deduction is $6,350.
For a single person at the
For a
moment.
single person. So Sam was able to take it, but Marie and Philo, they were each able to take $6,350 under the current plan. Now,
If they filed separately, but jointly, it's
Oh,
$12,700.
it's the same thing. It's the
Yeah.
together. It's the total is the same. Okay. In addition, the filer gets a personal exemption unless their income is in the $400,000 range. It phases out. So, in the current system, filers have the possibility of a $6,350 standard deduction plus a $4,050
Personal
exemption. And if you're a married couple, both of you are filers, so you both get that 10,000, what is it, 350 and 50, 10,400 per person. Plus your children, your dependent children get the 4,050. Okay. Now under the Trump plan, there's going to be a much larger standard deduction, 12,000 per filer, right? So Sam gets that 12,000, or the married couple gets 24,000 under that, but they lose the personal exemptions. So it sounds like it's going from 6,350 to 12, but it's more like going from 10,4 to 6. Right? And so that's still a good deal if you don't have dependents.
Yes.
But if you have dependents, it's not a good deal.
And so the families that will be hurt on that will be the families that have more than 2 children, will be significantly hurt. So that may be an unintended consequence.
Surely
Okay.
they thought it through correct.
Pardon?
Surely they thought it through carefully.
There are really not a lot of details out there yet, so I don't know how much, where the thought process is. So what happens to the tax rates? So you look at the tax rates, and the average rate is 12.17% for Marie and Philo. The effective rate is 9.25%, but instead of being in the 15% bracket, they jump to the 25% bracket on the next dollar of income earned. So what happens? So you want to be careful on how you read this in the press if they go ahead and say, gosh, the average tax under the new system is going to be 12.17% for a married couple with 2 children. It looks like it's a better deal, but that's just because the tax and the numerator and the denominator both increased. So they're paying more taxes. It's not a winning situation. The effective rate is 9.25%, and then that marginal rate jumped up. So consequences. Well, the details have been pretty scarce. And so what's going to have to happen is the House Ways and Means Committee will take up this legislation, and the Senate Finance Committee will have to talk about it. My experience in studying tax over the years is that what is introduced is not what is passed. We could see some interesting things happening. The reasons why Sam is a winner is because of this increase in the standard deduction. The reason that Marie and Philo are losers is the loss of the property tax deduction, the loss of the personal and dependency exemptions, and the loss of that student loan interest deduction. So here's a possible unintended consequence. Since Marie and Philo no longer have an income tax incentive to continue giving to their university's foundation, they discontinue their annual $10,000 contribution. Okay. Single Sam still has no income tax incentive to make a charitable contribution, and so he doesn't begin. And another question was, what are the estate taxes? So estate taxes, they are a tax on your right to transfer property at death. So it gives you the right to transfer property at death. You can transfer it to a charitable organization, and that is not taxed. You can transfer it to your spouse, and it's not taxed. Okay? And the reason when it's not taxed when it goes to your spouse is that just increases the size of your spouse's estate when she passes, and it's more likely that it will be taxable if you combine both of your values instead of just one. So currently, you don't have to pay an estate tax unless your estate is worth at least $5.49 million. You got to go over that. Okay? No matter who receives the estate, you know, it's got to be more than $5.49 million before you have to worry about it. The current proposal would do away completely with the estate tax. So there are a lot of arguments, pro and con, about this, but it's interesting that only about 1 out of every 700 deaths results in paying an estate tax today, and that the vast majority of states, 99.1%, do not pay federal estate taxes now. And that's a big difference from what it used to be in the past. Big difference from what it used to be in the past.
I think it was changed around 2010, and I think that at that time the limit was about $1 million.
Yeah.
And they raised it significantly and indexed it for inflation, the exempt amount. So it goes up every year. The next year it'll be more than 5.49 million. And for a couple, double that,
right.
A married couple.
No.
No. Yes.
No.
Yes, it is.
No,
Well,
not unless if they die singly, it's each 5.49. But if the husband dies and leaves 5.4 million to his spouse, and she has 5.4 million separately from him, after he's gone, she has 10.8 million. Her estate is now larger than the 5.49 million, and she gets to pay estate tax. Okay? But still, that's 1 out of every 700 deaths. So at one point, you know, the highest participation or payment of estate taxes was 8%. And the number of people who had estates that were large enough to possibly require an estate tax return were much greater than that. But they hired good tax attorneys and tax accountants to take advantage of all kinds of trust provisions so that at their death, they did not have an estate tax. Another little fact, in 1976, you could only pass an estate on to your heirs or to friends $60,000, and beyond that, it was taxed. If they had not indexed, the exclusion amount, the median family wealth as of 2013 was $81,000. So that meant that 50% of the families who would have a death would end up paying estate taxes today if they hadn't indexed it. So that's pretty interesting. There's another argument that said, well, you know, the family farms are being driven out of business because of the estate tax. And there was something that I just picked up this evening that indicated that the average family farm is worth just a little bit less than $600,000. So the average family farm is not the one that's going to be eliminated by the estate tax. It's the very large family farm that is at risk. All right, so what would happen if we eliminated, okay, very good. So what would happen if we eliminated the estate tax? There are a couple of things that are a concern. The concern is that instead of getting property at the current fair market value, then what would happen is you'd get your old basis. You'd get the basis that Grandpa paid for it, the price that Grandpa paid for it. And if you went to sell that property, then the difference between what Grandpa paid for it and what you could sell it now would be a taxable gain. Okay? Yes.
Can I have an example on that? So if I inherit a piece of land that my grandfather paid $5,000 for it, and it's now worth $500,000, under the old system, I wouldn't have paid any taxes on it.
That's correct.
But now, I'm not paying any, if they do away with the Trump, the estate tax under the Trump system, then when I sell that property, I will have to pay capital gains on the difference between the $5,000 my grandfather paid for it and
That's right.
the value now. So my capital gain tax, as a consequence of doing away with the estate tax, would increase substantially.
Right. So yes, we will have a substantial increase in capital gains taxes if the estate tax goes away. And that's supposed to offset some of this revenue that's going to be lost. But it's going to dip down a lot further maybe than what they think.
What's the rate of capital gains taxes, 15?
It depends. Right now it's between 0 and 15 and 20. So if the person who has the inheritance of some property and sells it is in a very low income tax bracket, they'll still be okay. But if they're in Marie Philo's bracket or Sam Single's bracket, they're going to have to pay capital gains tax.
Can I continue that? So then, in my example there, I would not, I mean, the estate of my grandfather would not have had any estate tax, but it's not a big estate, I'd be paying capital gain tax. So it's,
That's
again,
right.
it's the rich that benefit, because they won't be paying any estate tax on their $10–20 million estates, but I'll be paying taxes, capital gain taxes instead.
The very largest estates, yes, they don't pay estate taxes.
No, I know.
You know, we look at that little 0.9%, and the biggest estates, if they do their planning, they don't pay because they leave their estate so that future generations get to benefit from it for a while, and then after that generation gets to benefit from it, it kicks it into a qualifying charity, and it escapes taxation that way.
So if I want to have my grandfather's land tax-free, I need to keep the estate tax.
Or never sell it.
But it's not good, yeah.
Yeah, but so, you know, the family that inherits the farm, you know, that's living out in Los Angeles and inherits the farm up at Bushnell, they're not moving back. So they're going to sell it, and they're going to incur that capital gains tax.
Can I clarify, just to be sure I understand? So currently, if I inherited my father or mother's house and I sold it, I would pay no estate tax if I had, I would pay no capital gain tax because it would be considered part of an estate?
What would happen is if you got it as an inheritance and the house is worth $100,000 on the day that your parents passed away, when you received it, it would be treated as if you paid $100,000 for it. And so when you sold it for $100,000, it would be $100,000 minus what you paid for it, $100,000, zero gain. But if they eliminate the estate tax law and they don't make a provision for property to go over, and right now they're not talking about that, they're saying no because they want to have that capital gains tax. You get the house at $100,000. It's not going to be a qualifying personal residence. You get the house at $100,000, and your folks paid $10,000 for it back in 1956. You've got a $90,000 gain when you sell that, and you get to pay capital gains tax on it if your income is high enough. Okay? So for the larger family farms, eliminating the estate tax could be an incentive not to sell that farm. But here's something that people generally don't know. In 2010, the estate tax went away for a year. We didn't have it. And charitable contributions to foundations across the United States dropped by 39%. So I had one colleague who said, "Oh my God, that's terrible. Those people, the only reason they give to charitable contributions is because there's a tax benefit." I said, if that's what it takes to get them to give to charitable foundations, I'll give them a nudge. But I choose to focus on the fact that 61% of the people continued to give their charitable contributions, not because there was a tax incentive, but because the heart was in the right place.
Or were those people probably, I mean, was that drop just on people with estate taxes? Or on just, or you're talking about contributions in general?
No,
Because
people with estate taxes.
Just estate taxes?
Okay. Yeah.
But I find a foundation, it makes a big difference to me. It doesn't matter
Crushes
what your motivation is. I'm 39% down.
Yes. Yep.
That's a big number.
That's a big number. Yes, go ahead.
Another effect of it, though, for big fortunes is that you just have a society with an inherited aristocracy of wealth.
Yeah.
And they brilliantly styled it as death taxes, but it's actually unearned income if it goes to children, because the children did not choose their parents.
Mm-hmm. Yeah.
So much
They've-
for the land of opportunity.
Yeah, they've called it a death tax since about 1862. They used to just charge like a stamp tax to file your will, and to pay for the Civil War, they created a legacy tax that got nicknamed a death tax back then. But if you're looking at, has the estate tax been effective in the United States? No. No. For the industrialized powers of the world, our estate tax has not been effective. In the last 30 years, we've seen a greater gap between the haves and the have-nots, even though we have an estate tax. So,
Well, it's got such a big exemption.
well, so
It
remember
wouldn't
that-
make any difference, you think, to a small percentage of the population having such a big amount of the nation's wealth if they didn't have a $5 million exemption?
The $5 million exemption helps a lot. Yep, because like say 8% of the population used to pay estate taxes at the highest payment rate. If they had frozen the exemption rate at $60,000, then 50% of the population would be subject to paying the estate tax.
Wouldn't that redistribute income?
Well, it would redistribute wealth. Yes.
Well,
Yeah.
yeah.
But at 60,000, if they had frozen it at the 1976 rate at $60,000, somebody in a lower income bracket couldn't inherit mom and dad's house and be able to maybe begin to create a better life for themselves, because they'd have to sell the house to pay for the estate
But
tax
they
to be
more
paid.
than index that 60,000. I mean, that
I mean,
60,000 is not equal to is not
No,
equal
no.
to 5.5 million
No,
now.
that if we index that to 2013, the last time we had wealth numbers for families, if we index it to 2013, it'd be $310,840. And the average family wealth, now this is the average, this is why I wanted to give a different number. The average family wealth is $528,000. So the average family would pay estate taxes. However, the median is $81,000 in 2013.
So 50% of households of estates are
Well,
81,000 or less.
yeah. Yeah, for 2013, the median family wealth was 81,000. So those are some consequences.
So Greg, the result of doing away with then the estate tax is making the gap bigger between the haves and the have-nots. The rich will be keeping more of their money and getting richer.
Right.
Okay.
That
And
could-
we'll be paying capital gain tax on our.
Yes.
on our-
So you'll be paying capital gains tax, okay? The gap will probably grow. If you're thinking that the current estate tax is effective in reducing that gap, it is not. So the current estate tax system is broken. How to address that, you
Need to
know?
increase the estate tax, not
Right.
decrease it.
Or, you know, another way to improve the wealth gap is to increase opportunities for those who are trying to climb out of the economic cellar. And that's what a lot of the folks in this room have done by participating in education for all these years, right? Creating opportunities.
Well, an argument for not eliminating it entirely was that a big chunk of money came from it, even with the big and large exemptions, right?
Yeah, about $19 billion a year.
And so the tax burden, if you eliminate it, is just going to fall on people that make less money.
Right, right. So that $19 billion will have to be made up somewhere.
Or you have bigger deficits
Yeah.
and you put it on your children.
As far as the total revenues that the federal government collects in different types of taxes, it's less than 1% of the total revenues.
One thing that's not being considered here, not that's going to happen to Trump, but I would rather that people were taxed and their income was used rather than it go through a charity system. I think there's a fundamental problem with relying on charity. I think my tax dollars should pay for things. I mean, I do give for charity, but just because the system isn't any good. But to incentivize charity as opposed to incentivizing taxes, I think there's a problem there.
Well, it depends on the charity. You know, there are charities that are very effective in taking that and being very effective with their spending. There are charities that are a disaster, and there's incident after incident after incident where the federal government, state governments, when they have spent your tax dollars, have done a very poor job of managing those funds. So, how it whether the benefit to society is through a charity or through a governmental agency, you know, that is kind of who's going to be more effective. Find the most effective folks and let's work with those folks, whether it's government or a charity. So the next topic that I've been asked to address briefly is the alternative minimum tax, and that's you've got the regular tax system and then you have the alternative minimum tax system, and you calculate your tax liability with the regular tax system and then you start over. And you calculate it again with the alternative minimum tax system. And in the alternative minimum tax system, they take away the presents that are in the tax code that make income taxed at a lower rate or exclude some income from taxation. And the idea is that some of that income, those differences are temporary differences. And so it smooths out the tax liability for the high rollers, right, over time. Except it's not indexed for inflation. And as a consequence, it's no longer a high rollers tax. It's a middle income and moderate income and high income tax. And given the dollars that they collect from it and the compliance cost, they almost pay more people pay more in compliance cost than the federal government generates in revenues. So either it needs to be overhauled or it needs to be eliminated, but as it is currently, there are problems with it. Maybe indexing would be a way.
I'll just point out, this is something that should have been indexed and wasn't. The amount that the amount that you would have to calculate the alternative minimum tax line. Because this was meant to keep the scammers from people who really work the system and take all sorts of deductions that probably weren't really meant to be used that way, to reduce their taxable income way down below what most of the people at their income level are. That was the idea behind the alternative minimum tax when it was introduced, which was in like around 1970, I believe. And it was because somebody did a report that showed there were a number of what would be millionaires today who paid zero taxes because of taking what some of us might have called abusive deductions. And I'll just point out that the only tax return we've seen of Donald Trump's was 2005, and the only taxes the majority of the taxes he paid were because of the alternative minimum tax. So it sometimes works, but it's not been indexed, and that's a real problem.
Yeah. This is $38 billion. So either fix it or...
And if it's fixed, Well,
then if it's,
bring in more, I don't
Yeah.
know.
But even as it is, it's the people that have the more money that are paying this alternative minimum tax.
oh, no, it's reaching down and hitting married couples. You know, you're over $130,000, $140,000 in income for a married couple, and you're likely going to have to calculate whether you have an alternative minimum tax or not. You know, it's amazing, if you use tax software, they make you check to verify that you don't have an alternative minimum tax, and that tax software is sold to millions of people who are low and moderate income, but they still are checking for that AMT. Okay. So, you know, one of the things that you could do, you know, other than indexing this, is getting rid of those preference items that they're abusing.
Well, and supposedly, one of the selling points of the tax reform plan is to get rid of lots of deductions. That's also, and the raising of the standard deduction then is supposed to make up for some of that.
Yeah.
Yeah, and I'll just excuse my skepticism about whether all those special ones will go away, but
I would suggest if you want
I'd
to,
be all for that.
yeah, if you want to read a book that is an excellent story about the Tax Recovery Act of 1986, and the political process hasn't changed. It goes through the House Ways and Means Committee, and it goes through the Senate Finance Committee. Read the book called The Showdown at Gucci Gulch. The Showdown at Gucci Gulch. And that highlights the work of Dan Rostenkowski and Senator Brady and a guy named Don Regan and another guy named Ronald Reagan. And it was an incredible journey from where they started to where they ended up. So that's why I say, you know, don't let your blood pressure get too high over the proposal, because what comes out at the end is probably going to be very different.
And
very
Gucci
different.
Gulch refers to the lobbyists.
Yes.
And I think there are something like 400 lobbyists for every single member of Congress.
Yes.
On every possible issue you can imagine.
When the Tax Recovery Act of 1986 passed, the lobbyists out in the hallway were stunned. They couldn't believe that the vote would happen. So it's an excellent book. I suggest you pick it up.
Well, there's a big incentive for the legislators to cut out those preferences, because it just gives them so much leverage to raise money from the lobbyists to put them back in.
Yeah. Or a whole lot of money to keep them in. Right. Okay. So another question is, you know, the media has a lot of stories out there about, well, you know, so many of the people in the United States don't pay income tax any longer. Well, that's true. The regular income tax, 45.3% of households have a zero income tax liability according to the Tax Policy Center. That began with the reforms of the Tax Recovery Act of '86 and went on through 2001. And it's growing because standard deduction and personal exemptions have been indexed. Okay? So if you eliminate those, wow, all of a sudden we could go backwards on the percentage of households who have an income tax liability. So it's a nice interaction with the greater personal and dependency exemptions, reduced tax rates, the earned income credit, the child tax credit, the additional tax credit. All of those things have contributed to this nice rate of 45.3% of the people who file tax returns have zero income tax liability.
Is that just federal tax?
That's federal income tax, that's correct.
Yeah, we're only
Income
talking
tax.
about federal here.
Yeah, so there's a difference between income taxes and employment taxes, okay? Big difference between income taxes and employment taxes.
Yeah, a lot of those people are paying payroll tax.
Right.
That's the next thing, yes, exactly. So the lower income families have been able to avoid the federal income tax because the government decided that it wasn't a good idea, right? So you've passed these income tax laws that have made it possible for the 45% of the population not to have to pay an income tax, but they are all still participating, unless they're under a state system or the railroad retirement system. They are not paying Social Security tax. I mean, they are paying Social Security tax. There's a very few exceptions where you don't. Everybody pays Social Security tax, right? They all pay Medicare tax. Now, those are so that you have a social safety net, a kind of a mandated or forced pension system, and a mandated health insurance system. Employees and employers both pay Social Security and Medicare tax. The federal unemployment tax and your state unemployment tax, those are paid by your employer. Okay? There's 3 exceptions for the state unemployment tax. The folks in New Jersey, Pennsylvania, and Arkansas, both the employees and the employers pay state unemployment tax. Okay? In the literature, they say the Social Security tax is a regressive tax, because if you have people with taxable incomes greater than $127,200, the Social Security tax stops, right? 6.5%, and it stops. So it's proportional until then. After then, what happens is your average tax rate declines, because your marginal tax rate for Social Security tax goes to 0 after 127.2. Right? And the Medicare tax, it doesn't stop. It's just a proportional tax. It's 1.65%, and it just continues. Right? The other topic that they asked about was corporate and small business rates. So they have proposed reducing the maximum corporate rate from 35% down to 20%. It's an interesting concept. The current average corporate tax rate is 15%. How they want to pay for part of this is that they would eliminate the ability to deduct interest expense in the calculation of taxable income. Well, that is a huge portion of the expenses paid by corporations. When we go to the next slide, you'll see what the impact is from eliminating the interest expense deduction. Really quite amazing. One of the incentives here, the complaints about regular corporate income, is that it's taxed twice. Corporation earns the income, they pay tax on it, right? Then the corporation's board of directors declares a dividend, they send you your dividends, and you get to pay taxes on it. So by the time it goes through 2 sets of taxation, it can be reduced significantly. So that kind of gave the incentive for people to have small businesses in these, what they call flow-through entities. Instead of having to pay a corporate income tax and then have a dividend declared and have that taxed, they do a flow-through entity so that when the business earns the income, it doesn't pay a separate tax. It's your responsibility, the owner of the business, to pay the tax on that small business or flow-through income. So it's only taxed once. But with a maximum individual rate of 39.6%, they were like, well, that's not going to work if the corporations are only paying 20% and capital gains rates are 10 or 15 or 20%. So they have suggested that we should whittle it down to a maximum rate of 25%. The devil is in the details. They're also indicating that there's a 3.8% tax on small business and net investment income that is a surcharge or a surtax that is embodied in the American Affordable Care Act. That also would be repealed. And so where we would get that 3.8% funding that goes in to help supplement the Medicare system would be troublesome. So the revenue impact, this is a little bit small, but the interesting one as far as all the numbers that don't have brackets around them, those are things that reduce the tax revenues that the government receives. And so the reduction in the corporate tax rate from 35 to 20% will cost the government $1.8 trillion. But the elimination of the interest expense deduction will raise $1.1 trillion. So the net corporate change is about a $0.7 trillion benefit to the corporations. So maybe that 20% rate isn't where they'll settle. If the moderates in Congress prevail and they can get a 26% corporate rate or a 27% corporate rate, that might be a wash.
And that's kind of in line with most first world kind of countries.
As far as a maximum
I
rate.
think that 26% is
Yeah.
the sort of the norm.
Yeah.
For,
Yeah.
But the one that's really interesting to me is the repeal of the itemized deduction other than mortgage. That's going to reduce,
No, that's
that's
going
going to increase, yes, sorry.
to increase tax revenues, but it's
Right.
going to pull
So-
money out of the pockets of those people
Yeah,
who
so
could
it's going
do
to cost the
mortgage
taxpayer
interest, or excuse me,
1.5 trillion.
yeah, the property taxes and any other deductions going to cost 1.5 trillion.
So we end up paying that 1.5 trillion.
well, and the other deduction that that eliminates that will affect a lot of people is the deduction for state and local
State and local income taxes.
income taxes.
Property taxes, yep.
Yeah. And that,
Local government.
Is that in the same thing that,
Could you go back?
that
Yeah,
she was
it's in
asking
the-
about? That's in
it's
the.
in that same one.
That
It's
1.5
repeal of
trillion.
all itemized deductions
Okay.
other than the mortgage interest and charitable contributions.
And that's of real interest. A lot of states, northern states and the coastal states have high state income taxes.
Right.
So it will affect the people in those states a lot.
So it just depends on the area in the United States. So we have some states that rely solely on a sales tax, and their sales tax rates are very high. We have other states that rely on an income tax, and we have some states that have both. And currently under the federal tax law, you can choose whether you deduct the state income tax or whether you deduct the state sales tax. So for those jurisdictions that do both, there's an incentive for people to plan when they make their big purchases for sales tax purposes and lump them all together so they get a tax deduction 1 year for sales tax, and the next year they can flip back and go back to their income tax
Okay,
deduction.
so both of those things would be eliminated.
Yep.
So it doesn't really favor one set of states' plans
Nope.
over others. Okay.
No, it eliminates some of the bias that was present before when only income taxes could be deducted. Then they put in
Okay.
sales or income
Okay.
so that the states that had the sales tax would not be discriminated against.
Okay.
Go ahead.
I don't know if you guys, you do this, in Springfield, they have a free tax service where they help you file your taxes. Are they doing that again in February? Do you know anything about that?
So in Macomb, I believe they do that through the Rotary. Is it the Rotary Club that does that? The VITA program, and Dr. Stephen Rock has run that.
Yeah,
Yep.
Oh, there's a place in Macomb?
so somewhere in the country.
Yep.
Yeah, it does it at the Y usually.
Yeah, does it at the YMCA.
If there is an approval of, if they reach some kind of a tax change, how soon after it's passed is it implemented? Because we pay taxes for a year and we file at the following year. So,
Well, it used to be that when Congress would change tax law, they would change it effective for the next tax year. But in modern history, was it back with the Reagan group that they made it retroactive to do the tax cuts back to the first of the year? And since then, when they've had tax cuts or tax increases, they've made them retroactive back to the first of the year. So if they pass something in November, it could go all the way back to January 1st, and we could be caught short.
The total tax cost is 2.5 trillion. Out of, how much does the revenue, does the income tax take in?
Now that's going to be what, over the next 10 years, it's going to cost us.
Right, it's over.
Our total tax revenue.
They always talk in terms of 10-year costs.
So, yeah, in 10-year brackets, the total tax revenue, if it doesn't change for inflation, total tax revenue is $3 trillion a year right now. So if we have zero inflation, we'd be at $3 trillion a year total tax revenue.
Anything else, quick? Well, I really want to thank Gregg for doing a wonderful job. And Kenny, who assisted with it, and Michael for taping it, and Bob for helping with some of the electronic stuff. Thank you all for coming. I really thank you very much.